We put the sign up, and it was 2 days later, I get a call from the neighbor. Hey, I think your house was broke into.
Oh.
We go down there, and it is all torn apart. They stole all the copper pipe that was in this house. And they probably did $7,000, $8,000 worth of damage. The whole house was completely destroyed.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hey everybody, I just want to remind you that the RPOA Annual Conference and Expo is coming up at the end of this month, February 23rd, 24th, and 25th, right here in Grand Rapids, Michigan. It's an event you don't want to miss. Go to rpoaonline.org to find out more and to register for free. Hello and welcome to episode 56. My guest today is Joshua Schaub, who bought his first rental property at the beginning of the Great Recession in 2008. He's since grown his portfolio to 25 units, consisting mostly of single-family homes and duplexes, and he specializes in purchasing, renovating, and creating high-end student housing in the Grand Rapids area. In 2011, Joshua opened his own real estate company, Icon Realty Group, representing buyers and sellers in the Grand Rapids home market. Joshua, thanks so much for being on the show today.
Yeah, thanks a bunch for having me, Brian.
So why don't you tell us a little bit about yourself, how you got started in real estate?
Sure. So originally I am from northern Michigan, grew up on a dairy farm up there, and I was just kind of that kid that didn't really fit in with everybody else in the family. Now, that wasn't necessarily a bad thing, but most of the time, on that tractor or out when I had lunchtime, I would be reading books. I would be reading stuff about leadership or stuff about how to start a business. So it was a little bit different for me. I knew what I wanted to do from a young age. I just didn't know exactly what to do. That was kind of my problem. And so from there, it was what to do. Once I got to college, I knew I wanted to go to school, and I ended up going down to Grand Valley and Grand Rapids here. And that was kind of my point of what do I have as a major besides just general business? Because once I got there, I declared that, but I wasn't really sure where do I go? Do I want to do accounting? Do I want to do marketing? Do I want to, what could it be that would really be something that I can be passionate about? And so that was why I came down to Grand Rapids. And, I remember my freshman year and that summer that went into my sophomore year, I kind of had this entrepreneurial spirit of trying to find a way to make money that would be sustainable. I know I tried to do something called Team, which was like a multi-level marketing company selling different products. I looked into a vitamin company, and I did that for probably 8 months and was somewhat successful. I made actually pretty decent money doing that for a little while. But it was always, once you stopped working there, it all fell off really quickly. And so it was, how do you find what was true passive income, something that I didn't have to keep working for all the time? And that was my problem. Is I always like to automate. I always like to find ways to make it a little simpler. Or, the problem was I wanted to find something that I could walk away from and still be able to have a company or business that could run after I was away from it. So that was kind of where I came from. I remember my freshman year, I spent a lot of time trying to make these sheets for bunk beds that zipped onto them because I had such a problem of always making my bed. So that was one interesting thing that would always come up. So that, just to give you an idea, I was always trying to tinker. I was always trying to mess around with something.
You're doing some inventing, huh?
Yeah, and it was always just, how could I improve things? How could I invest with things? For a little bit there, I opened a candy vending machine business and tried to put machines around different parts in town. And, trying to find ways to make money was always my passion.
Did any of those ideas ever hit?
None of them stuck, unfortunately. So it turned out to be, a good learning experience, you can say, in the end. I never took any massive loss on anything, but it was just, very entry level, but it gained a lot of experience for me.
Talk a little bit more about the multi-level marketing, because a lot of people who find their way to real estate investing have gone that route. They want the entrepreneur route. And multi-level marketing is kind of, a great way to start your own business. What's your takeaway from it?
Yeah, so I agree with that. That's a great spot you can start where You don't need much money. I mean, usually the initiation fee is minimal. I think ours was like $200 to buy in or something. It was great in terms of building your skills to network and talk with people. I think if anything I got out of that, it was, you pushed that product or that type of service to people. You had presentations, you refined your pitch, and it does, like you said, it carries over to real estate really well because you learn to be comfortable talking in front of people, maybe ones you haven't met, or you have a very, it's a friend of a friend. And, so that helped me the most there. But overall, I mean, for just me personally, I know there was a lot of success stories of people that did well, but that was not necessarily something I was passionate about. And so after a little while, when I figured that out, there just wasn't much more draw to that for me. So eventually that's why I backed away from it.
So to really do well, you have to commit even more to the product or the company.
Yeah. I mean, from the people I talked to, you'd have to put 2 or 3 years in before you really start to, you can get away from a full-time job or something. You really have to have a lot of work where you do it. And that's the way with
real estate is similar too.
It's
right?
the way with any
you got to
business.
work hard at that as well.
I agree.
So go on. You were at Grand Valley State University trying to figure out your path.
Yeah. So my sophomore year, I was right in the middle of my sophomore year. And this was kind of I would call it my aha moment. I came across the book that I read. It was called Rich Dad Poor Dad by Robert Kiyosaki.
I've never heard of it.
It's actually, no one talks about that one.
That's
one of those key books.
Gem, huh?
Yeah, it really was. And it was easy to read. It's something that's a simple book. It's classic. And really it boils down to him having 2 fathers that one had a really good paying job and seemed to, as life went on, didn't really get ahead very much, where another one who might have had a job, I believe he had something where he had a few different businesses, might have been like tool and die shops or something. As time went on, he bought more and more, and he grew into different businesses. And so that was a kind of an awakening moment. Wow, that's really interesting. I never really thought of growing businesses would be a way to make your living, because at that point I was in school to find a high-paying job. I mean, I wanted to go find something that would pay me 6 figures a year, which is every kid's dream when you're done with graduation. But that kind of split my switch of, hey, maybe that's not the end all of everything here. Maybe my retirement plan or my 401k is not going to be the thing that makes me rich. And so I went on and read the second book of that series called The Cash Flow Quadrant, which talks about the 4 types of income there. And it talks about that there is basically 4 main types of income. It would be being an employee, working for somebody, being self-employed. So that's, you bought a business, but it can't run without you. Well, it's income from an investment. So that would be more passive income. And then there would be something of income from a business, which would be you can actually step away from that business and it can run without you. So that was my big opening moment of, hey, wow, this is interesting. I need to get into a job that's not just I'm an employee. I need to get into a job where I can have true passive income. And so that was really nice for me. So kind of a funny story. So that whole book talked about real estate investing, talked about rentals, talked about apartments. And the year before my freshman year, I actually had some student that was in the same class as him. And he mentioned about doing rental properties. And he brought that up and doing renovations and doing nice properties. And I was at that point where I was looking for a high-paying job, And I remember him saying, "What do you think about this idea?" And I was like, I just kind of laughed it off. I was like, "No, that's not something for me. I don't want to be someone that fixes toilets." The general answer
I
you're
don't
going
want
to
to
get
answer
from
phone
somebody.
calls in the middle of the night.
Yep, I don't want to be the landlord. And I find myself 1 year later, almost exactly, and I'm like, "Wow, I should have looked into that."
Who was
further.
that student? Is that
So that was actually Joe Poland.
Joe Poland,
Yeah.
who I talked to,
Yes.
probably 10 to 15 episodes ago.
Yep, we were in the same class together. I think it was, second semester freshman year or something like that. And he mentions that to me, and I didn't even think about it. Now I'm like, oh man, I should have, definitely jumped on board. But, live and learn.
Now he had started a real estate investing group.
He did.
At Grand Valley. Were you part of that as well?
I was here and there, not as much committed to that. I was kind of out on my own trying to learn it
you
for
had
myself.
not yet realized that. Oh, so you were trying to do it on your own.
I kind of was.
Okay.
I went there a few times.
Kind of the lone wolf.
Yeah, exactly. I went there a few times, but it was just, I was like, okay, let's see if I can figure this out. What can I find? All that. But, it was, looking back at it, I was like, wow, I should have use the potential and experience of there was some other people that were teachers there that had some experience in real estate. There was some students that were doing that. And so I would have saved myself a lot of time.
What year would this have been?
This was 2000. Oh man, going back now. This was 2005 into 2006.
Okay, so that the timing is interesting because had you gone out and gone whole hog and said, okay, I'm going to buy now, 2005, 2006, you would have been buying at the top of the market.
I would have been.
So maybe it's a good thing you didn't take it as seriously at that point.
I agree.
And waited till 2008.
Yeah, it actually worked out really well because when I first started really looking seriously, those prices were probably as low as they could go at that time. So it worked out. But, in terms of experience and learning from people, I wish I would have started a little earlier and just kind of dragged my feet and learn from other people's experience.
Yeah, at least lay the
firsthand.
groundwork, get the education, get the knowledge.
Yep.
And as an aside, a lot of people feel that we're in that place again right now. At the top of the market, and we'll be talking about that because you're a realtor as well.
Yes, that's true.
So you have a perspective on that. But anyway, go on. So where did you go next? What happened there?
So I was looking what's going to be my true path. Will it be these rental properties? I read some books about. Would it be worth my time to flip homes? Would it be worth my time to just do them as investments? Would it be worth buying tax liens? Or possibly, I've heard of people doing wholesaling where you find a home for cheap, you find an investor, you kind of can make that money in the middle as margin for it. And I went through all those, and eventually in 2008, I bought my first set of homes. So this is kind of a crazy story. Unlike most people who would go on the MLS at the time and find a realtor or anything like that, I actually bought 3 homes at one time, and I found the person on Craigslist. So it turned out it was a person who was a bank asset manager, and so they were advertising just everywhere because they couldn't sell anything at the time. And what he told me is, hey, I have these 3 homes available. One was right on the northwest side of Grand Rapids, kind of close to where Grand Valley is now by the Seidman College downtown. And that one was the most interesting to me. And
what street was it on?
It was on Hovey Street.
Okay.
So right there, a little bit south of Fulton, probably 1 block south. And that was a duplex, which I thought was perfect. That's really what I wanted. And there's 2 other ones, one on the southeast side, and then there was another one on Hamilton Street, kind of on the northwest side, right by 131, just a couple blocks west there. But
at the time, I mean, back then, those were C and D type neighborhoods.
They were,
but they've really changed since then.
They have, and so I remember going in there, that first house. So I bought all 3 of those houses for $25,500, but they were
a piece
total.
In total.
It was, right? Don't you wish that would be the case today? But they were junk. I mean, they were on the MLS a couple times.
I remember. I have to tell you this. I remember looking at a 3-unit that was probably near Hovey. Right in that area that was a foreclosure, and it's probably the worst house I've ever seen. Someone had actually gone to the bathroom number 2 on the wall, and that was just the beginning of how bad this house was. So there were some really bad houses over there.
It's crazy the things you would see in walking through some of those foreclosed homes. I mean, like you said, that I wouldn't put it past anything. I remember I went through one before where they left and they had cats inside, and the cats just same thing, bathroom all over the house. I mean, it was just ruined. I mean, ones where we've gone through, I went into a basement one time, there was someone down there living there.
Yeah, you'd walk in and find people living there.
It was nuts. So that was, getting started right around that time. I got started as a realtor shortly thereafter, and it was scary walking through those homes. I remember I would have, and this is on the northwest side where the neighborhoods aren't terrible anymore. They're actually pretty nice, but I'd bring my big mag light just in case, and you never knew. But
never knew when you'd have to go to battle.
No, exactly. Exactly. Yeah. So I bought those homes. They were trash. I remember talking to the guy, and I was like, how do I get inside of them? And he didn't have the lockbox codes. He was just, we have them from the bank. You got to buy them as is, whatever. And I was like, well, I want to see them first. He goes, well, I don't know. Just break the lockbox off and take the key and open it up. And I'm like, that doesn't seem very, very legal, but, I was able to peek in the windows and go through it.
The guy you were talking to, he must have purchased these from the bank then, huh? You weren't talking to a bank asset manager. You were talking to someone who was just trying to flip.
No, it was actually a bank asset manager.
So this was a bank asset manager telling you this.
Yeah, so they had it from, each one was owned by a different bank. So it wasn't even the same one. So they were some third-party vendor that just, they packaged these together and sold them off. So, I mean, over the next couple of years, he would give me packages of 5 or 10 properties at a time, which I couldn't buy that many at that point. But, I mean, that
was a good relationship.
It was.
Let's take a little break here so I can tell you a little bit more about our 2017 Michigan Landlord and Real Estate Investor Conference, February 23rd, 24th, and 25th of 2017, right here in Grand Rapids at DeVos Place. And registration is free if you go to rpoaonline.org. And here's what you're going to get. 7 national speakers. Robin Thompson talking about buy and hold and rehabbing investment strategies. Tony Youngs talking about hidden market strategies in today's current market. Tom Zeeb talking about his rapid cash generation blueprint, how to quickly make money without money in real estate. Sue Huyuela, vacation rentals, Airbnb, the secret to doubling your rental income without tenants using Airbnb. Vina Jones-Cox, the fastest and easiest way to wholesale properties for big money. Brad Sumrock, talking about earning double-digit returns and retiring early by investing in apartment fortunes. And Mr. Landlord, Jeffrey Taylor himself, talking about his new Take Total Control program. And we have some excellent breakout sessions as well. We have our annual economic forecast, as well as Grand Rapids future development. Other breakout sessions include real estate investment and asset protection, our very popular Don't Do What I Did and Idea Minute breakout sessions. Come to the deal room at lunch. This is where deals get done. We have a special panel on house hacking, marketing and screening for tenants, prizes and giveaways that you don't want to miss. Registration is free. Go to rpoaonline.org to register and secure your seat right now. So go on with these 3 houses.
Yeah, so the first one I bought, so I would consider the first one, somewhere in that price of $7,500 if you divided that total by 3. And we put about $50,000 of work into it. That was a duplex. And my whole goal at the time was to live there for free. That's kind of what I read on the books and everything.
Were you going to do the house hacking, live on one side, have your tenant on the other side, pay rent, which covers your mortgage and expenses?
Yep, and I was even cheaper than that at the time because I got a roommate to live in my side with me too. So I was living essentially free. The one side covered the mortgage. The roommate covered all my utilities and all the bills that we had associated with the home with their rent. And so I was just, I was living where I didn't have to have any payments or anything like that. Now this was probably the point of learning to be a landlord, gaining an experience that, looking back on it, I should have done a few more things, a few more improvements to the home because, first of all, I'm scared if I can get it rented out. I don't know if I can get anybody down there. My hope was to get some students like me around my age so I can relate to them and whatnot. I get these students in there. We rent it out for like $5.99 a month is what it's turned out to be. And I didn't replace any of the windows in the house. So we did do the siding and some insulation and carpet and stuff like that, but I didn't do the windows. So there's these old single pane wood windows. And when winter comes around, him and his roommate come up there and they're like, our heating bill to keep this house at like 62 was over $200. And it's, it was probably 700 square feet down there. I mean, it shouldn't have been that high. And so that kind of started me off on the wrong foot with these guys from the get-go. And it just wasn't, it wasn't a great relationship because of that. So now I learned, do the nice improvement, do it so it's energy efficient. And after we put the windows in, I did it the next year after they moved out. I believe the bill went down to be half of that. So it was about $100. So, I mean, just learning, I just wasn't aware of how to do that. So over the course of the years there, I renovated the 2 other properties I bought. I hired a handyman to help me out. My first set of tenants were okay at one property. The next property, I had a set of girl students from Grand Valley that moved in there, and so they were paying. I mean, it was like $700 for this 3-bedroom home. I mean, it was nice, but
single family 3-bedroom home.
Single family 3-bedroom home.
But those were the rates back
Those
then.
were.
That was the market rate.
Yeah, and you know, at that time, that was the house on Hamilton. It wasn't the greatest of neighborhoods. At that time, you have a few foreclosed homes on each street, so you know, it wasn't great. It wasn't prime, and so these girls, they were willing to move in there, which was great, and they were the easiest people to deal with. If they had problems, most of the time they try to fix it themselves. They would pay me rent early, which was a big surprise, and I was like, okay, you know, I got my tenants at my property are pretty decent. The tenants at this one, I had these other ones that were okay. They were always a little late, but it, you know, wasn't the greatest area. So I bought a few more cheap homes. And so I went on, I bought one on 4th Street on the northwest side, which wasn't kind of in the great blocker area. And I bought another one down in Kentwood. And both those tenants were not great. And that was kind of the turning point of, okay, I'm spending a lot of money to get these properties repaired back up after these people leave. Their security deposit wasn't covering everything that was in damages. I had one time I went over there and the people were moved out and everything was left there, trash, beds, everything. So then I had to hire someone to come through, and that was, you know, it took me probably another 30 days to get it rented out after we got it cleaned out. And so, you know, there's more vacancy. And so I start looking at these books and I'm like, even though I'm buying these low price properties, it's not a great return after all the time I put into it and after all the money that we have to do to get it back up to.
And you're managing yourself.
I am.
Probably doing a lot of the work yourself too. So you're not even valuing your time.
No, then that was the problem was, you know, it was just more and more time, more and more problems, more and more repairs. I was learning on the fly. I don't say I'm a handyman by any means, but it was a hard, you know, it was a hard situation of trying to manage all that. You were on call all the time. And that's just not where I wanted to be. So as I went on, you know, I got bad tenants. It spurned into becoming worse properties. And so I didn't know what to do. And the other part is I'm 21 through 23 at this time in my life. And I'm getting these families in there and no one's paying rent. No one's taking me seriously. You know, I'm trying to, hey, I need you to pay, I need you to pay. And they're laughing me off. And, you know, I'm trying my best, but it's still like, I can understand where they're coming from when they're looking at me.
What tools did you have at that point? I mean, did you know how to manage these properties, or were you just kind of learning on the fly?
I was learning on the fly. I mean, I had Excel spreadsheets to manage accounts, basically. I set up my own formulas. For bills, it was all me, and there was no system, no structure. I had a handyman person on call that could do the work that I couldn't do if there was an emergency call. But overall, I was starting to drown was the problem. And so I was like, okay, I need to see if I can change something here. So I bought a house. This is kind of a turning point here. Was I bought a house on Valley Street near the 50 bus line. And so my thought was, okay, these girl students down at this other property were really good. Maybe I can get students in here and maybe I can make the property a little nicer. So I improved this property a little better than my other ones. Nothing by means anything super nice, but I threw some stainless steel appliances in there. We replaced some of the cupboards and make them a little nicer. We just tried to touch things up so it showed a little better. And lo and behold, it actually rented to a young professional couple. They were probably the best tenants I had. I was renting it for, I think it was about $1,100 a month, this 4-bedroom home, and they would pay on time. They were easy. They fixed everything. I think we had two calls over the course of a year. It was easy. And I was like, okay, maybe I need to start moving into this type of neighborhood, this type of home, something a little larger where we're attracting to, a better clientele is really what I was going for. And so I bought a few more homes on that street, and we started to copy the same model, and it was really interesting. I noticed the neighbor to one of the houses I bought this really big cedar duplex on the same street. And every once in a while they'd come in and they were doing renovations, but they were doing it fast. I mean, it would take me probably a year to get something done with this handyman. I'm trying to do the work, we're doing it together. And these guys would come in and they get all this stuff done and the whole siding done in a few weeks. And I was like, whoa, this is crazy. These guys move fast. And one day I'm out there and I actually run into the owner of the property who's talking to his contractor while I'm outside talking to my contractor. And So his name's James, and he starts talking with me about that he has a management company, how he does his properties. He actually showed me his property, and it was nice. I mean, I'm going through there, and I'm like, wow, he's got hardwood floor, and he's got, I mean, this one he had granite tile, and it was just everything that I wished one day I could do, but I just wasn't at that point yet. So I chatted with him a little bit. He's like, hey, what are you planning to rent these properties for, these two other properties that you don't have rented yet? And I said, well, I'm probably thinking like $1,200 because my other one down the street rented for $11. And he goes, oh man, I can rent these for $16 easy for you. And I was like, what? And he's like, I'll manage them too. And I'm like, that's a double bonus because that's just telling me right there, I don't have to deal with the management side anymore. And, I'll make more money than I thought, before what I was doing it myself. So that was good. And that was one of those things where it's like, all of a sudden I realized managing it myself, I wasn't as aware or as in tune of rental rates as a property manager was.
Yeah, how were you setting your rental rates?
I was just kind of guessing. I mean, I was looking at some other homes in the area, but the problem was at that time, all rental rates were low. I mean, if you were looking on, most of the time it was Craigslist and RentLinks were the two websites that would attract people. And I would go on there and, everything was $800 to $1,000, maybe $1,100 if you had something pretty nice. And that was, okay, maybe mine can set the top of this market. But lo and behold, these guys were doing a really, really nice job, and they could get really high rates. And my properties were close enough where they thought they could. And it was 30 days later, both of them were leased out, and we were getting those top rates. So that was really nice. And so then that was my discussion. James was a really nice guy. He sat down with me and he goes, you kind of have to make a decision on where you want to go with this portfolio of properties you have. You have some that are nice, some that would fit the mold of kind of what you want to do, but you got basically two opposites. I have these single family homes that are spread all over the city that have what I would consider low quality tenants in them. And then I have these other homes kind of all clustered together on the northwest side that could appeal to students or higher end business professionals and nice homes. And so it's like, what do you want to do? So I made the decision it was time to sell off my other homes that just didn't really fit the mold of what I was doing. And we went through, and some of them I broke even. Some of them
when you sold them off.
When I sold them off, yep. So I sold 4 of them off. And some of them I broke even on, some of them I made a little money on, and then one interesting one, the one on 4th Street, we put the sign up. We agree, okay, we're going to sell it. Person moves out. We put the sign up, and it was 2 days later, I get a call from the neighbor, hey, I think your house was broke into.
Oh.
And we go down there, and it is all torn apart. They broke in the back window. They stole all the copper pipe that was in this house. And they probably did $7,000-8,000 worth of damage. They took every single faucet. They went through there and just cleaned it right out, but the whole house was completely destroyed. And so I was able to sell it as is, take the insurance check, and just walk away. But just to give you an idea of some of the homes or some of the areas at the time, if you left it unattended or if there was nobody there, it was.
I remember looking at a lot of vacant properties and seeing that someone had come in, opened up the wall, and taken all the copper.
Yeah.
I don't know how much that copper was worth, but it certainly wasn't worth the $7,000 or $8,000.
No. I'm just like, well, at the time, I think I was guessing it was maybe a couple $100. It was just, wow, this is rough. And so, if you were a landlord or a property manager just yourself at that time, that probably would have been one of my lowest points of being, hey, maybe it's not for me. And that's where I hear a lot of people that they get into that, they start in the business, or they did it a long time ago, and they have something like that come up, and they're like, is it worth it? Is this even a point? But I would encourage you to push through, because, I pushed through. I was like, I was already kind of setting that goal to move to something else.
Well, it's good you were able to assess your portfolio so early on in your career, because, had you got rid of the dogs.
Yes,
had you kept those dogs, they probably would have been dragging you down all along. So
that's very true.
It's important to look very clear-eyed at what you have and say, what can I get rid of that's just, that 80-20 rule.
Yes, exactly.
20%, what is it? 20% of your properties are going to cause 80% of your problems.
And that's very true.
So get rid of those 20%, and then you won't have any problems.
Yes, exactly. Yeah. And that was totally the case. I remember there was 3 of those houses took almost all my time with those tenants there, just because there was something going on. And so it was trying to streamline. And I was really appreciative at the time to take some good advice from some good people, just saying, hey, I remember talking to, at the time, I got my real estate license because I wanted to start keeping the commission check for myself. And Tom Coetzer, who was the president of the RPOA at the time, was my broker. And so he was holding my license. And, I asked him, hey, do you think these homes on Valley are a good area? And he's like, yeah, I think this would be a better neighborhood than where you're going. And then I'm talking to this James guy, and he's telling me, you got to figure out what you're going to do with your portfolio and get a goal and go on a track. So that was, the advice of those two guys at the time, that was very helpful, because who knows where I would have been if I would have just kept going down a path, and I might not have been able to turn the ship to where it is now. So I guess kind of going into the next stage after I sold all those off, it was kind of what I considered, gaining knowledge as an investor. What did I look for? So I got, instead of focusing just on the price, because that's really what I initially started with. It was, is this the cheapest thing? How much in renovation is it going to cost? And okay, then I'll buy it. I started getting a little more picky in terms of, I was looking at the area. I was looking at the size of the home, because I started to see that these bigger 4-bedroom homes were kind of bread and butter. I could spend almost as much on a 4 as I could a 3, just a few $1,000s more to renovate. But that's one more room I could rent out to people. And so that was one thing I was always focusing on. And then the other thing was, as I started to focus a little bit more towards students, what's the proximity to a bar or restaurant that people might walk to? How close is it to the downtown Grand Valley campus or downtown CC campus? And where is the proximity to a bus line? Because some people don't have cars or they ride their bikes.
Well, yeah, you mentioned the 50 bus line.
Yeah.
And if I recall my conversation with Joe Poland, that was his strategy.
It was
to buy right along the 50 bus line, because that's where students would live and take the bus to Grand Valley.
It's very true. And I rode that bus for 3.5 years, 4 days a week. And I got a good idea to the feel of that neighborhood. But yeah, there was a huge demand of, those students didn't mind jumping off the bus and having the house right there. And, you could if you live downtown, you could go to Allendale, to the big campus there, or you could go just right downtown in a matter of probably 3 minutes on the bus. So that was really convenient for students. And so that was kind of the strategy I kind of pulled in my mind too, was, wow, that's really nice. And so I was looking at that, and then I started purchasing homes kind of at an increasing rate. I would say 1 or 2 a year. I was trying to take the money that I made in profit of one and put towards a down payment of the next, and just keep using that snowball of income to keep purchasing homes. One thing that was really nice looking back at it was my ability to live in that duplex, because I was living there still for free, and I was working. So after I got done having the management company take over for the properties for me, I got a full-time job working for the state of Michigan.
Oh, so had you had a job up to this point?
Up to that point, I had not.
So you got out of college and just became a real estate entrepreneur.
Exactly. It wasn't like I wasn't trying to find something, but it was bad.
Well, it was a tough job market.
It really was.
You bought those initial 3 houses.
Yes.
How did you finance those?
So the initial 3 houses, the cash I had, I actually bought those with cash. Because
you needed 25 cash to buy them.
Yep.
But then you were putting probably well over 100,000 into repairing them, or upgrading them.
So the first one, I actually got a loan from my father on the first one. So he had some money saved up, and so I knew if I could do it, I could possibly refinance out of it and be able to get probably 75% or 80% of whatever I put into that house back out. So he fronted me the first set of money.
So he fronted you the money.
Yep.
You improved the house, and then you were able to get a loan to refi?
Yes.
Or cash out?
Yeah. So it took me probably 18 months to get that first loan. And so then I had the cash, and I paid him back, and I had a little bit of money of myself still saved up, because I was working odd jobs. I had student loans. When I took the student loans out, it was kind of crazy. They would just let you borrow your max amount of your loan amount. So I actually had some money saved up in my savings account from these student loans that I wasn't working yet. Some of them were deferred. You could ask for longer deferral.
So you were able to use some student loan money to finance your real estate.
It was kind of crazy that they let you do that, but I did. And so unlike the other kids that were, they would take that money and go spend it or buy a car or, something like that, I hung on to it. And when I did those next few properties, it really wasn't a whole lot to fix them up, because I tried to do some of the work myself. And so then it was just material plus hiring a handyman with me. And I probably put $15,000 in each in terms of investment. So they weren't, like I said,
you had to come up with an additional 80.
Yeah.
So 50 you borrowed from your dad.
Yep.
Some of it came from your student loan.
Yeah, it was kind of crazy.
Yeah.
So once we got those, then you could get a loan on those again, get that money back, and then I had some money to play with where I could, the property I bought after those ones, my fourth property, I paid, I think it was $14,000 for. Again, I only put about $10,000 into it, so I was slowly buying these cheap ones, but it wasn't the right ones to purchase. So it was nice that someone believed in me at the beginning, that they would actually give me the loans to get started with it. And once I had that, then I took those, sold those off, used some of that money to go towards these other homes on Valley, put that towards renovations, and then again got loans to refi those as well. So slowly I was fixing the home up, taking the cash out of it, fixing the home up, taking the cash out of it. And then we had some equity.
So, now, what you were doing there makes sense.
Yep.
But the timing, and here, when I think back to that period, anywhere between 2008 to 2012, really.
Yeah.
Banks were very particular about lending. So you must have had quite a time trying to find a bank that would let you do a cash, not just do a cash out refi, which a lot of banks didn't want to do at all at that point, but even do a loan with you if you did not have W-2 income. You didn't have a job.
Yeah.
So how did you find a bank that would work with you?
I went on a lot of meetings with loan officers. Eventually, my best option was to get a cosigner, is what I found out, and to have a business opened. And if I had it as a business, sometimes they said that you would be able to get a commercial loan for properties. So then I was able to basically, I was taking it as what they would call like a blanket loan. And I would move it into them. They would basically see some equity in the home because I was using some cash to fix it up. And then they would take that loan and they would give me a portion of that money back out of it. So it was one of those times where it was crazy. It probably took me 3 years to get, up to a point where I could do loans where I could walk into somewhere and actually they would believe me. I could get a construction type loan for a project and then actually work on it and then get a refi out. But most of the time I had to have my cash. I would have to use some of my dad's cash, like we were saying before when I started, and fix it up and then get a commercial type loan to get that cash back out. Or there was a few different lenders at the time. I don't remember what the company's names were, but they would actually, after I had the home for a little while, they would give me a 30-year note on them. And let me basically cash out refi them. But then right around end of 2012, 2013, I hit a wall. It was hard to get any of that. And so then
I kind of maxed out the number of homes you could do that with.
Yeah, no longer were they doing the commercial loan for me. No longer were they doing, I talked to the same lender I had before that did a couple for me. They weren't doing those 30-year cash outs anymore. They had new rules and lending restrictions. So then it was, where do I go from there? How do I find the funds to get started with something new? So that was always the challenge was, if you're growing this business, it wasn't too hard when you had these really, really low income price point properties. But as I grew it and you started to put a little bit more money into these homes, financing was definitely the challenge, especially when you're a younger guy and you didn't have that income and I didn't have anything to fall back on. So it was nice when I started working at the state of Michigan, because then I started having, after 6 months, I had W-2 income. People would see it as a 30-year, I could get a 30-year note, or I can move into, if I wanted to, I can move into a new home, do a low down payment. So,
So in a way, getting a job helped further your real estate investing.
It did. Because, it was hard when you're not really working yet. You can't, they're using your tax returns. They're trying to say you're self-employed, and people were trying for me. I appreciate it, but there just wasn't much to work with.
Banks, they've got their boxes, and you didn't fit in their box.
Exactly. And so, I didn't have a proven model yet either. And that was the thing, is I needed to find a banker I could trust, or someone that could trust me, to show them, I can prove this model, and over time, this will be successful. I've had the track record of these being leased out, but they actually, they want to see it. They want a cosigner. They want to make sure that you can actually do what you're delivering. So I was very lucky that my dad believed in me, that we had some of those funds that we could use at the time, because I know things were tight for everybody. And, I just was able to kind of snowball some of that debt into something more successful. And we held on and got some good properties until we finally could get financing for myself is really how it worked out.
So is that what you're still doing, is self-financing, or maybe working with your dad, or have you moved into raising money from other people?
So from that point, I haven't worked. My dad and I have partnered on 3 properties from basically 2012 till now. And those are the same type of property, same type of model. What I do mostly is I just finance that myself, in terms of I can get a construction loan now on a property. We have the down payment money from all these other rentals coming in. And so it's just kind of a snowball effect of, as the income comes in, I'll take that money, I'll use that as my down payment. We renovate the property to whatever level we decide we want it to. And then at the end of that time period, we will actually do a refinance off that loan and do it into either a 15, 20, or 30-year note. So it depends on kind of what our strategy is for each different person. But I have not raised... I'm starting to get to that point where I'm talking with other people about raising money, doing partnerships with other people that, might be outside the family, and, seeing how that might work out for us. But I haven't gotten there yet, but I think that will be definitely somewhere I'll be going down the road, because I know there's opportunity there. It's just a matter of finding something that works for everybody that's a fair deal. Mm-hmm. So.
Continuing the same model, or maybe moving into something a little bigger?
It might be something bigger. So, single family homes, love them. I think they're really great. The last few years, I've been doing a few more duplexes, and I would see myself probably down the road trying to do some sort of small apartment complex. So, nothing huge, 8, 12, 16 units, if there's something of that sort around here, but just something to dip my toes in the water, get a feel for it, and see if that's exactly what I want for me. I think we could make it successful, but, the prices out there, like we've even talked about previously, it's just right now the market's hard to find that right deal.
Yeah, so you're someone with your finger on the pulse of the market, because you started a realty group, Icon Realty Group.
Yep.
And you have realtors working for you, and you're out there helping buyers and sellers. So talk a little bit about that.
Sure.
And what you're seeing in the market right now.
Sure. So I got my license as a realtor in 2009. And basically the reason for getting it was no one would let me in the properties, because they weren't, if you're looking at a $30,000 property, it was kind of hard to get a realtor to come down there right away the same day to get you in there. Usually they would push you off for a few days. And so I was like, okay, maybe I could save myself a little commission money. And then I would have, most of all, access to the properties right when they came up. And so started from there. 2011, Icon Realty was born. To this point today, we have 14 realtors in our company. So some of those are part-time people. Some of those are full-time people that do that as their job. And I'm the broker of the company. But the market has changed. I mean, when I'm looking at 2009 or 10, prices were low. We all know prices were low. We wish we could buy as many as we could today at those prices, but they're just not there. Probably up till 2013, I thought it was, still kind of stagnant. You'd see a good deal here and there. It'd pop up on the MLS. You could get to it pretty quickly. You wouldn't have to be in there the first day, and there would be multiple offers. But the last probably 18 months, it's been a lot busier out there. So it's a competitive marketplace now. It's where I'm taking buyers and sellers through homes. I mean, I've taken a few through just the past handful of weeks, and first day it's listed, we get through there, and it's highest and best offer, and they have 8, 10, 12 offers, and that's frustrating for people. It's kind of frustrating for me because I like that negotiation just from my standpoint when I started to get people a good deal, get them in there. So there is deals from an investment standpoint too out there, but they're just, you have to be willing to take some risks. But what I mean by that would be, you would have to be willing to maybe go outside of that comfort zone of where you think your parameters are for a good neighborhood. So some people draw lines on maps for searches, and I keep finding myself buying homes at the fringes of all these areas, trying to guess where is this market going to move to, because that's really the only place right now we've been able to find good deals for investors. Is you have to be willing to trust us and just take the risk of, we think it's going to be good. It might not seem great right now, kind of like when it was where I moved into my duplex when I was a kid. That market has changed. I remember there was 5 foreclosures on, it was a half block area. I mean, it was small, and there was 5 foreclosed homes there. Now every single one is full. It's nice. It's renovated. Now half the street is students. It's kind of crazy, but so you have to kind of project where that's going to go, and that's really been my MO to people, is that's where you got to follow. You got to follow where these trends are moving to and try to beat it too. Now, have we been wrong before? Yeah, even I've been wrong. I bought a house on Bates Street on the west side of Fuller, and I kind of thought that maybe the momentum from the southeast side and East Town would kind of carry through and make that a much nicer neighborhood, and it didn't. It's still fine, but it wasn't what I was projecting it to be. But most of the time we can do pretty good on finding areas and finding properties that are going to be nice in the next few years, or you can buy now and get equity and have cash flow, and down the road you're going to be sitting where you can sit back and pay that thing off and have that investment or that retirement you're hoping for. I mean, that's what we're all doing this for.
Well, let's talk about that, because you just recently acquired something, so you are still buying. I mean, it's not like you've stopped and
True.
You're kind of sitting on the sidelines like I am.
Yeah,
You're still out there buying. You also brought a case study here.
I did.
So why don't you tell us a little bit about this property?
Sure. So I bought this house this beginning of this summer, I guess late.
Single family house.
Single family house, maybe late spring, somewhere in that time frame. And it's located in Cherry Hill Historic District. So the first thing that piques my interest is, from a rental standpoint, okay, historic homes are a little bit harder to maintain because you can't, if you're not aware with that, you can't put vinyl siding on them. You can't put those new
you put vinyl windows.
Vinyl windows.
You got to replace like with like.
Exactly. So
if it's a wood window, you got to put in a new wood window.
Yeah, and that's the problem. Is sometimes that's not as energy efficient, but that's what those associations they want, and I understand that. You keep that character of that neighborhood, so I'm all on board there. But I knew if there's a home for sale there, usually there's some equity. There's only so many homes that are located in historic areas, and so there's a potential for equity there. But it makes sense from a cash flow standpoint too. So went through there, checked out this house. It was actually in really nice shape. It had a fire previously. I think they said it was somewhere in the range of like 5 to 7 years ago. Upstairs had a fire, drywall now, new electrical. They put a new bathroom in there. So that was really, really nice for me. I was like, okay, those are some things I'll look for in a new home. They also had new plumbing for that, which was great. And when they went to sell, they also put a whole new kitchen in. Did real nice countertops, real nice those cupboards and stuff had the anti-slam doors on them and everything. I was like, wow, nice. They did a good job with this. And there was some space there to build a bathroom. There was this huge living room, and then it had this kind of funny breakfast nook that was a little too small. And at the time, the house was 4 bedrooms and 1 bath. And I know it gets tight in those college houses. You don't want people fighting all over 1 bathroom. And I knew I would have to at least build another bathroom in there. And they also had this huge, it was a kind of a dining room with these pocket doors. And that was another thing for potential of, hey, we have this huge living room and still another area to make a dining room. I mean, it was so big we could have really just chopped it up. And so what we did was we actually took that dining room and made that a bedroom as well. So at the end of the day, we looked at it and we said, hey, this could be a 5-bedroom, 2-bath home with a little bit of improvement here. There's a lot of stuff done, but there's a few things that still need to be done for it. So made an offer. They luckily accepted it, and it was very quickly. And so we offered $160. They took our offer, and so we went from there. We went to work, and after everything was said and done, after we did the loan and some of the closing fees, and we did a new furnace there, a new air conditioner, washer and dryer weren't included, so we did that. We had some issues with the sewer, so we were working the sewer lines using the water, and it all backed up. So one of those fun things as a landlord you don't foresee is, we had to bust out some concrete in the basement, drain the line, put a new line in, everything there. But after all is said and done, we put about $40,000 of total repair costs into it and loan fees and everything. So I was able to walk away with a total investment of right around $200,000 on this property. But this property was really nice. So it had, like I said, nice kitchen, stainless appliances, it was a nice quartz countertop, really fancy. We put a nice granite countertop in our bathroom, tried to make it big and spacious. Upstairs was tile shower. And the 4 bedrooms upstairs were really big. They already had closets in them. And that room downstairs that we converted from a dining room to a bedroom, we built a closet in there. And that's a real nice space. I mean, when you're living with some roommates or whatever, I mean, our ideal target would be students or young professionals, but with a 5 bedroom, you're probably going to be students. Mm-hmm. You want to make sure the rooms are going to be big enough because that's kind of their own space. That's where they're going to be going to a lot of the time is, they need to fit a desk and some dressers and room in a closet because, that's where they're going to probably be doing some schoolwork in or whatever, along with their bed. And so we went through all that and we were able to get it rented out. It took us 3 months afterwards, after we closed on it, to get it fixed up, done, finished, and leased out. And we were able to lease that out for $22.50 a month. So
wow.
Really nice return on that. And so when you look at it,
so how does that? Let's talk about the numbers there. So you're getting $22.50 a month.
Yep.
What kind of loan do you have? Did you get a construction loan on this, or how'd you finance it?
Yep. So at the beginning we did a construction loan, and so that covered the cost of basically purchasing the home, and then I had the rest of the money that I was going to do. It's saved in a bank account. We used that for the repairs. And then after that was all finished, we just refied that out into a 30-year note. So the terms of that turned out to be, I think we got 4.25% interest rate percent on that.
Really good on a rental property.
Yeah. We were really happy. Luckily we got it done before.
4.25%, 30-year fixed.
Yep.
Wow.
And so that turned out to be a pretty good payment. So when we boiled it down and I looked at my $40,000 that I had to put into this loan, it turned out to be that the cash on cash return, which is what I use usually to measure my investment, was right around 20%. So I would expect those $40,000 would come back to me in about 5 years.
So all right, let's dig into that deeper. Cash on cash return, which is basically if you had, what'd you say, $40,000 out of your pocket?
Yep.
If your cash on cash return is 20%, that means you're putting about $8,000 in your pocket every year.
Yep.
After all your expenses.
After everything was paid off, that's what I should expect for my return to be. Yep.
Okay.
And so I usually, when I'll run those sheets, I'm going to be expecting some sort of vacancy rate. I'm going to be expecting some sort of repair or maintenance cost to that. We're going to be, most of the time, these properties are pretty nice. So, like I said, I didn't see any big issues coming in down the road because now we have all new appliances. We have a new furnace and air conditioner. We had a new water heater installed. So I don't see any big issue items that should be creeping up to get
no real
me.
deferred capital expense items.
Yep. The only thing would be this one still has that asbestos siding on it. So maybe one day I would like to change that. I know the city always, would like that too. That might be something.
But it's historic.
But it's historic.
So there's that push and pull there.
Yes.
The city would like you to change it.
Yep.
But it's a historic property.
I know.
So,
yep.
And you're supposed to replace like with like. So
what
would you even replace it with?
I have no idea.
You'd have to go back and say, well, is there wood siding under that? And if there is, then
exactly.
You're probably going to have to redo the wood siding underneath.
It would probably have to be all new wood. It's probably in bad shape from what I could understand.
I'm sure it is. And they put asbestos siding over it. It probably is in bad shape. Yep. So that may be something you don't even want to touch.
It's very possible. And that's one of my things where right now I was just going to leave it as is because besides how long that stays on there, that could probably be the only thing I could see as maintenance down the road. But you don't want to, if it's working, I don't want to mess with it because, less cost, less headache, less hassle.
The last thing you want to do in a historic district is go put or vinyl siding on your property and then have the historic commission tell you, nope, you got to go undo it and put this in there instead.
Yes, yeah, no, they'll get on your case. I mean, they'll know before you even start. I think sometimes I wonder if they know when you're thinking it, because they're out there fast.
They have mind reading machines.
They do.
Yeah, they have that now.
Yeah. So, I mean, that would be one thing that might come up and creep up, but really my goal is to keep those maintenance and repair costs down over the next 10 years as low as possible. And so that's kind of what reflects with how we do it, and the level of renovations that we do now is, going back when I first started, it was you tried to cheap out and, I can make that roof last another 5 years. I can make this work. The furnace is old, but let's just wait till it dies kind of thing. And now it's, okay, I don't want to come up with these unexpected repairs, big repairs that could come up down the road in the next 2-3 years and surprise me. I'd rather just have it where I can project what my repair maintenance costs are going to be, because we're pretty good at that now. We have a good idea over the course of all these properties of it's going to cost me X amount per year, and the rest, if there's more damage, most of the time that's going to be the tenant's fault. That's something that would be billed to them because they're in nice shape.
So you like to go in strong
Yes.
up front. Enough money to do everything that needs to be taken care of.
Yes.
You don't want to defer any items. So you're going to make sure when you buy a property, you have enough funding to do everything that you need.
True.
Need to do.
Yeah, I mean, that's I joke with people when they're asking me, what are you looking for? And I said, usually the worse, the better, the condition of that property, because I find it, there's a lot of things that maybe aren't done right on some of those mid-tier properties, and you have to go back and, to run electrical, when it's being framed is a lot cheaper than to try to run it behind drywall or try to, add a few new outlets or run grounds or something. It's smart to do it from the get-go and to have everything squared away, because it just makes more sense to me that I can do a project, I can spend all my time on it, I can work on the layouts, I can work on the renovation, I can talk to the contractors, I can talk to the management company of what's our strategy for who we're going to market to, what's the price going to be, but everything's taken care of when I walk away, and it's is almost truly passive as possible. And repairs are part of that. I mean, repairs are one thing that I think, if I'm giving advice to people, and that was kind of one of the things I was going to mention later, was repairs come back to bite you, and you're not even aware of it, because a lot of people will run numbers or cash flows and not assume that there's going to be these big repairs down the road. People always estimate low, and it costs money to replace a roof, and it costs money to do all these things. Some of these houses I've heard where people don't replace the electric and it's knob and tube, and people have air conditioners and they're always popping the breakers, and they're getting mad and stuff doesn't work. That's a bad relationship with the tenants, but eventually that's something you're going to have to fix, and that's a big cost to you. You might as well just do it right from the beginning, so you don't have to spend your time to go back to a project after you've completed it.
Yeah. What do you typically budget for those types of repairs and improvements?
So I guess as a total, I try to do everything at one time. So when I'm looking at a project, I'm trying to say, hey, what would it cost to do just all of it? That's what I'm drawn to. This one was a little different that we used as a case study because it was already done after that fire. But usually the budget would be, we're looking at least $100,000 in repairs for most properties
repairs and improvements when you buy the property.
Yes,
to get it up to your standards,
exactly.
Where you're not going to have any deferred
yes.
maintenance issues.
Yep.
Going forward from that point, there's always going to be repairs and maintenance. So what do you budget for that?
So in terms of maintenance and repairs after we have something completed, usually I'm putting in about $1,500 a year is kind of my guess.
$1,500 for the property.
For the property.
If it's a duplex, would that be $3,000 a year?
If it's a duplex, it's about $2,000. So it's not a lot more.
But that's because it's already in good shape.
Yes, and so most of the time it's less than those numbers. But what we run into is you start saving up for that next roof, that next furnace, that next appliance that's going to break in 7 years or 10 years. So if you don't hit those numbers, okay, that eventually something's going to happen down the road, but it's so low at $1,500. That's usually more than what we even need, because a lot of the times what we will deal with is those calls for maintenance and repairs are something that either A, is fixed under a warranty from something we did, because usually we'll have 3 months, 6 months, or a year for something. So if the appliances are bad or whatever, they're covered by some sort of warranty. Or B, there it is something that's going to be where the tenant's at fault. So, I mean, I've seen them where they're throwing full pumpkins down a garbage disposal, or, and you never know what comes up out of those toilets when they're pulling it back up with a snake. And So those get billed back to the tenants of, what are you doing? That's not something that we're going to be liable for, because, that's kind of on you, was why it got clogged or why it got broken or whatever. So most of the time it's really good. And the best part of all is the tenants are super happy. And that's the big thing, is if we can keep them happy and they like the product that we keep putting out there, they're going to keep, not everybody is going to keep releasing with us or renew for the next following year, because we understand people move on, they graduate, whatever, life happens, they get married. But a lot of people are really satisfied with the quality of the property and how it turns out.
Yeah, and let's talk about leasing, because I know that you specializing in high-end student housing, you pre-lease your properties months in advance.
We do. So we try to flow with the season of Grand Valley or community college or even Aquinas. Sometimes we try to flow with people start looking. If you're on campus, we found that out. People start looking October. They're only on campus probably a couple months, and they start thinking, what are we going to do for next year? So right around the 1st of November is usually when things open up, and people start, these students will start thinking about, hey, where are we going to live? Who are we going to live with? What are we going to do? And they start putting their plans together. And so we'll actually market those properties. People will come by, start doing these pre-leases, check out the properties. And if they like them, they put their deposit down for the next school year. So many times we'll have a property that we'll say it's August 1st, 2017 is when it starts, when that lease is going to be starting. And we'll have that reserved by January, this month, this year.
So right now, and we're recording in early January.
Yep.
You are actively pre-leasing for August 1st of this year.
Yep. So I use American Realty as the management company, and that's their strategy, is try to get these pre-leased as quickly as possible. They do a great job, but I think right now, when I talked to them 2 weeks ago of where we stood, and we had 13 units already pre-leased for the following year. So
and that's 13 out of 25.
Yeah, so a little over 50% we're sitting on. It's pretty good. So
wow, yeah.
It just kind of speaks to sometimes the quality of what it is and what the students' mindset is, because a lot of times people ask me, well, what are they looking for? Is this too expensive? Is this too much? And you're moving out of dorms. I remember I lived in the dorms, and I was paying $650, $700 to bunk with somebody else.
Wow.
It was a lot of money. And so, first of all, you want the freedom of your own place, which is nice. And the other thing is most of the time they're not super nice there. They're nice what you get in the dorms, but they're not cutting edge or anything, fancy or spectacular. And you come down, you get your own place, you get to live downtown with your friends, and you also get something that is a nice home, and you make your own rules. Most of the time we don't have issues with damage or people treating a property poorly. It's just a matter of people want to get away, and if they want to stay up and be late and be loud and be noisy, they don't have those rules of a RA or someone in an apartment complex coming after them, for it. So it seems that that's a good appeal for what we're targeting.
So during the time that you were managing yourself, and now you have a professional management company managing for you, did you ever experience any horror stories with tenants or people you regretted renting to?
Yes. So I've had some rough tenants sometimes that came in there, and it was just a learning experience for me of some points to look at when you're looking to lease to somebody. One of those things were, I remember I had this really nice house down in Kentwood. We finished it up, really nice wood floor. It was beautiful. And these people showed up, and okay, all right, I really need to get this thing leased out. It's kind of crunch time. We got to get it done. It was a competitive price. And they talked to me, and I was on the fence about them. And they're like, okay, we want to put the deposit down today. And I was like, okay, I think this might work out. And then they pull out of their coat an envelope full of $20 bills. And I was like, oh, that's kind of unusual that they'd be carrying that much on them. And, I learned from that experience, because down the road, they would always pay me in cash. They became renters that would pay late. They became people that had a lot of other people living in this home, and it was only a 2-bedroom home, and we'd have a lot of people going in and out of there. And just the damage of it became, when they moved out, I think our security deposit on this one was like $650 or something. We had probably $2,000 to $2,500 just worth of repairs, and that was before there was a little bit of carpet in the bedrooms and stuff, and like, should we fix that too because it's ruined? And so that was one of those learning experiences of, oh geez, I should not.
Had you run any sort of credit check or history on them?
I didn't. And that was my problem. Was I got to the point where I was like, oh, let's just take the cash and go. That's great, and I shouldn't have done that. It was something I needed to learn from. But that was me, early.
Did you ever go to the RPOA, the Rental Property Owners Association, and
I did
take any of their training or use any of their credit history services?
I did afterwards.
Okay, so that kind of led you.
Yes, exactly. So I think it was right after that experience. Then I met up with the RPOA and I started taking more classes and learning a little bit more. And when I went to go rent out one of my properties again, when I was living in a duplex, someone came up with cash again and offered that to me. And I told them, no, unfortunately, I don't think this is going to work out. And do you have any credit history? And what's your job history? And they just were super vague on everything. And I'm like, I'm going to have to think about it, but we have a lot of interested people and I can get back with you. And eventually I did not get them into the place because I've learned, experience helps you immensely.
So it's a red flag to you if a tenant wants to pay you in cash right up front.
Exactly. I mean, they wanted to pay me that day in cash, prepay. And like that guy, he wanted to prepay his first month as well and just have it all right there for me. And I was like, that tells me maybe you have something on your credit score or you don't have a job or something's going on that you're trying to hide to get me just to sign it with you. So something to learn, and like I said, I didn't do the credit scores. I didn't do a credit report, anything like that. Something you really need to do now when you're getting good tenants.
Yeah, and just a quick plug for the RPOA. They help you with that. They teach you how to screen your tenants, how to market to the tenants, how to follow fair housing laws and rules, and how to avoid those kinds of mistakes. So organic plug there. I want to shift gears a little bit and talk about the current market. I mean, Here we are at the beginning of 2017. There is a lot of new construction going on in downtown Grand Rapids,
yes.
and on the northwest side, where a lot of your properties are located.
Yes,
most of what's coming online is higher end A-class housing designed for professionals and students. Do you see that as competition for the properties that you have?
I see that as somewhat competition. So I have this conversation a good amount with people when we're talking about if you want to get into rental properties, because they see all these buildings going up. They see all these cranes being out there building new structures. They see the newspaper where new buildings are going to be going in the next couple years. And they ask me, what's your thoughts on this? Now, my thoughts are our demand for our single family homes and our duplexes while our price is somewhat elastic, it's somewhat inelastic because of what we offer. People are looking to get away when these students, who would be our main type of target, when they are looking to get away from the dorms, they tend to gravitate towards a home. And kind of like I mentioned before, the prices of those dorms or the prices of those townhomes or whatever they were living at before generally are high. So we can offer you, for usually it's about $450 a bedroom if you broke down the cost of rent based on how many bedrooms we have. We can offer you a nice home. You can split all these utilities and all these costs with your other roommates. You could probably live there for maybe $50 to $60 more in terms of utilities and internet and all those other costs. And so for a little over $500, you get a really nice home. You have a backyard, you have parking off the street, and you are able to make your own rules on what you want to do. So,
and you get your own bedroom as opposed to sharing a bunk in a dorm room.
Exactly. And so while that's nice, I don't think we'd be able. My only concern would be I don't think we'll be able to continue to rise to bring those rents at such a high level as we have in the last few years.
Yeah, so we've had incredible rent growth in
yes.
the past years. I mean, in some cases, double-digit
yes.
rent growth. You don't see that continuing.
I don't. I feel like we might be able to do it at a small rate.
Well, take your 13 units that were just pre-leased this month.
Yep.
What have you seen rent growth in those?
So we did. Usually, we move those somewhere up between 3 to 5%. From what we had last year. So not a lot, but a little bit. And
it's still higher than average.
Yes, it's something good. And the years before we moved at those same rates, but I would not be surprised if next year or the year after, those would probably be flat, or we want to keep them the same to remain competitive with what's out there because, it's just there's so many units being built right now. Now, it's not exactly the same. Those costs to build those apartments are so much higher that they have to charge a high price for 2 bedrooms or 3 bedroom apartments.
Yeah. The new stuff coming online, they're paying a lot more per door to build them in construction costs than what you paid to acquire and rehab.
Exactly. So when you boil it down, if you're still looking at $450 a door or $425 a door, even if they're super, super nice, and let's say they're $475 a door, what you're getting in the quality of product is going to be very comparable to what you're going to get at that apartment, but it's a home and you have a few more people living there, but you don't mind that. Usually everyone's fine with living with their buddies for a year or two or even longer. So it seems to be that competition there it's real. I'm not going to deny it, but in terms of if it's going to take away where we're going to have more vacancy, I don't think that's going to be the issue. I just think we can't raise our prices at a huge and steady rate. That's going to be more of the issue.
Yeah. Well, it's encouraging to hear that you're actually achieving a 3 to 5% rent increase.
Yes,
right now in January.
For now, I'm interested to see what I say to you if I talk to you again next year. But for right now, it's been pretty good.
Yeah, well, you still have the back end 12 units that you got to
exactly
pre-lease, assuming that all your turnover is yearly.
Yeah, and most of the time it is.
Yeah. So as we wrap it up here, Joshua, what advice do you have? I'm going to tweak it a little bit here because, I usually ask what advice you have for other investors out there. But you were a student getting into real estate. You had student loans. I know some of our listeners, in fact, a lot of our listeners are in the shoes that you were in, however many years ago.
Yeah.
What advice would you give them, going out from college, from their education? They have student loans. They may not want to get a job like you didn't want to get a job. Give them some advice.
Okay, sure. The first thing I would say is when you're buying that first home and you're looking for that first investment property, or even something that you might, a good option would be something you live in yourself. It's your home, it's your primary residence, and you rent those rooms out to your friends. I mean, that's a good option. But when you're doing that, really focus on not just the price, because my problem was I was always buying the cheapest thing possible. Focus on what's around that neighborhood, what we would call in the real estate business as comps. So what do other homes like that sell for? And maybe yours is priced lower, the one that you're looking at or the one that you're interested in. And it could still be a good deal, even though it might be higher than what you might be willing to pay. And kind of using that as an example and moving into the next topic or next point would be have a measurable rate of return. So what is your goal? That's why I try to sit down with people. Do you want to make $500 a month after you pay everything off of cash flow? Do you want to have, what I have is I measure stuff on cash return. So how quickly does that money you have returned to you? Or some people who are seasoned investors will look at cap rates. So what is your measurable goal that you need to hit with this house? And what I do with every single one that I'm thinking about buying is I have a quick spreadsheet already set up with my formulas and everything. I run my numbers. I run my projected numbers of what I think those costs would be. And it comes out to X amount, so much percent. And if it's lower than whatever amount I have set, I don't buy it. I don't move on with it. And that's something that, you'd ask me, what are the repair costs, or, how much will it take to get to this point? Well, that's one thing you learn with time. That's the only X factor, is some people underestimate that. Some people aren't sure what the rent price might be, but have something measurable, have some sort of goal that you can really go after. That was something that I really used at the beginning, was cash flow. I wanted to have so much per month in income. And then now I've moved to cash on cash return as a measure. So like I talked about before, be careful on what your repairs will be. Don't try to scoff off on some things that might be problems down the road, or even, short term. If there's a furnace and it's one of those old octopus furnaces down there in the basement, chances are that thing's not going to last much longer. So either budget that in to just get it fixed right away, or make sure you have money saved up in some sort of fund that those repairs are coming, so you have that budgeted in. The other thing I would say is I learned a lot managing a property myself. I loved the experience of being the property manager until I didn't love it anymore. And I would say for your first house or two, do it yourself. Now, realize it's not true passive income until you turn it over to a property management company. It's really you bought yourself a job to a degree. But you learn a lot. You learn how to deal with people. You learn what tenants are looking for. You learn how you can relate to that property management company. But then if you really do want it to be a passive income, you need to learn to let it go, and you need to learn to turn it over, because you can't be the person that's always making those emergency phone calls. You can't be the person showing homes and trying to place tenants. You need to learn to step away, let the property management do what they're good at, and you find a better use, the highest and best use of your time, because that's really what you need to focus on. When I was starting to look at homes, something that would have been a super big help was finding a realtor who was also doing investment properties. Now, you don't know who is or who isn't, but you could call and just ask them, because I remember the first few people I talked to, they thought it was a good deal, because I asked them, hey, what's the best deal you could send my way? I read that in a book one time, so I figured that's why I should ask them. And they weren't really sure what a deal was, what I was looking for, And so if you're talking with somebody that knows or does exactly that, that would be the ideal person to find. And then tying that into my next point is find a mentor. Find someone that's doing exactly what you're doing, and pick their brain and take them out to coffee or go to dinner and learn from them, because that was helpful to me. Is over the course of all these different people and all these years and who I've met in contacts with, I've learned a lot of things. I've gained a lot of knowledge, and I've saved myself a lot of headaches and money by taking advice of people who did the same thing before me and were willing, and I was thankful enough they would pass on that information and wisdom to me to say, hey, don't do this. This is a problem. So that would be one of my sets of advice for you. And my final point would just be, be thankful for everything. Find a way to give back if it's your time. If you don't have a lot of money, just do that. I try to do that with people who come by and ask me, how do I get started? Can you take a little time to sit down with me? I'm never too busy where I don't have time for somebody else, because I remember myself 10 years ago looking to try to find a way to get started. And I know it's a hard journey, but, just find a way, some sort to give back, because, that's the best point, is to pass that off and pass your knowledge on to other people and see them do well. So that'd probably be my best points to say to people.
So what's the best way to get a hold of you if someone did want to do that? Yeah.
So if you want to get a hold of me, you can call me on the office number here at Icon Realty. So that our number is 616-216-2000. And so that's the voice message. I will be able to get that, and I can connect with you at whenever I get a chance and talk with you about it, because, like I said, I'm happy to talk with people, pick their, they want to pick my brain. I can see what they're looking to do and whatnot. Maybe there's an opportunity down the road. You never want to say no to somebody and not pass on some good information.
Fantastic. Well, thanks for sharing your time.
Oh, thank you.
Really shared a lot of great information with us today. Joshua Schaub, thanks so much.
I appreciate you having me on.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.